So just in terms of housekeeping, eventually, hopefully, we'll be broadcasting to the internet, so do be aware that anything you say will live on in infamy on YouTube to our millions of subscribers. So be conscious of that. For those of you following along on Twitter, our think tank is at SMF Think Tank. If you want to tag in the Investment Association, it's at INVASOC, and the hashtag for the conference is #LAB23. If there is a fire alarm, you should follow that guy in the green. He looks like he knows what to do with those hands. And just in terms of format, we'll go through, we'll have 5 minutes from each of the panelists and then open up to Q&A. So I'm going to start by inviting Karen Northey from the Investment Association, the representative body of the investment management industry, who hopefully should give us some idea of why we're not getting the investment we want and what we can do to increase it.
Thank you, and just if I can say thank you to Sarah, to Tulip, and to Simon for joining us, and for all of you, and apologies, we are standing room only. It's good news that people want to listen to what we have to say, but hopefully, as we've said, we can make it worth your while and have some insights that are helpful. So to give a little bit of context for those of you who aren't familiar with the Investment Association, we represent about 250 investment managers, along with about 150 fintechs that provide technology to improve the buy side within the financial markets. It is a big industry, it is a global industry, it supports about 126,000 jobs across the UK, some of those directly employed, but many of those in support of the industry. And to pick up on the point around some of the economic challenges, we have actually just this morning, as the Investment Association, released our numbers from 2022, our annual investment management survey. Sadly, they're very easy to remember. £10 trillion of assets under management, which is what our members manage, has dropped for the first time and quite significantly at the end of 2022. That has dropped to £8.8 trillion. That's still obviously an astronomical amount of money, and quite hard to figure out exactly how many zeros there are if you're not instinctively great with numbers. But the good news, there is good news on this, and I do want to focus on this. The UK asset management industry is one of the global success stories of the UK. We continue to attract not just investment from the UK, but from around the globe. In fact, almost half of the investment that our members manage is from investors overseas. So this is money that's sent here to the UK, and at the very high value skills and jobs that creates in terms of managing those assets. So that's still good news. There's about 4.2 trillion assets under management from outside. Now, in terms of investment, that money is invested across the world. There is an obligation on investment managers to invest in the best interest of their clients, and that will sometimes be investments in the UK, that will sometimes mean investments elsewhere. But the fundamental driver is this is not the money of our members, this is not the money of asset managers. These are your pensions, other people's pensions. These are investments that are held in ISAs, in a variety of instruments. But there is £1.4 trillion invested by these asset managers here in the UK. About 815 billion of that in equities, so there's been lots of discussion about how we can grow the investment in equities. So these are all numbers that have been refreshed as of this morning, but again from the end of 2022. And I should say 2022, for obvious reasons, has been quite a difficult year in terms of markets. Obviously we had the challenges with the mini budget last year. We've had the invasion of Ukraine and the repercussions of that. So plus the inflation and various other things, and it's sort of a bit of a perfect storm of challenges. But I do think we are talking large number, which means quite a number of very what seem like small changes can make a really significant impact on investment and on growing those assets that come in. And I would categorize them basically as three different camps or three different buckets. One, attracting more assets to be managed here, because decisions that are made locally, closer to UK assets and UK companies, has a knock-on benefit. In addition to the jobs that creates, the taxes that provides, it does mean decisions are made closer to the things that we want investment for here in the UK. And then there's lots of ways to do that. There's a big part of that is a regulatory framework that works and that's fit for the future. there's a tax implication. There are tax rules which we think, what seemed like very arcane things like zero-rated tax, zero-rated VAT on funds domiciled here in the UK. That sounds like foreign language to someone not in the industry, but that is anomalous here in the UK, and there's tax that's paid here versus setting up somewhere else. So there were lots of small changes. The next category is an important one, which is growing the amount of retail investment. So that is investment by individuals here in the UK. Historically, our industry is seen as an institutional market, but in the last 2 years, we've seen the percentage of assets that we manage that are retail in nature go from 20% to 25%. That's quite a significant jump. But we know from research that the FCA has done and others, there's still a significant amount of money sitting in cash, which interest rates are not keeping up with inflation. It's not good news for people who have large pots of cash. And there are lots of things we can do to incentivise that. There's the ISA regime that really does need a review. Incentivising investment into equities, for example, a stocks and shares ISA over a cash ISA, for example, is one of those. There is a lot of work going on making sure that individuals get the advice and guidance they need to invest. A lot of work working between Treasury at the moment, but also the FCA, getting around some of those regulatory barriers that are getting in the way of people getting the information they really need in terms of investing. Lots of others, and then finally, the other sort of bucket of changes I think fit into making it easier and more attractive for that investment to be done here in the UK, so investment here in the UK, because that sometimes will be incentives, that sometimes will be removing barriers, whether that be the pension reform, with a focus that has too long been on what's the cheapest, as opposed to what is good value for pension holders. So a real focus on value, which may mean higher fees, but long-term benefits for the economy and for individuals. It is getting capital markets reform right so that the UK market is a place to list and invest and to trade, and that's research into companies that's changing things like T+1, which is how trades are settled, consolidated, take lots of technical changes that have been put forward, making sure those happen, but also all the investment into things like net zero, making sure we've got clear transition plans for each sector, so we know what's happening. We've got policy certainty so that investors are confident when they put their money into UK investment.
Fantastic, thanks Karen. And next I'm going to invite Sarah Pritchard, who is Executive Director of Markets and Executive Director of International at the Financial Conduct Authority.
Thank you. Well, thank you for inviting me. It's great to see sort of standing room only. I just wanted to touch on what we can do as regulators in relation to making the UK an attractive place to invest. And I start with delivery against our statutory objectives. And I think in doing so, that can provide a fundamental underpinning for the UK to grow and to thrive. Our statutory objectives, as you well know, number one, to make sure that markets function well, and to do so with market integrity, consumer protection, and promoting competition in the interests of consumers. And newly, through the secondary objective, through the Financial Services Markets Act, to have a focus on doing so, supporting international competitiveness and growth in the medium to long term. I spent the last few days at conference here talking a lot about that secondary objective, how we're operationalising against it, what it means in practice. And you will hear me say consistently and repeatedly that we are really focused on that in relation to our regulatory reform. You can expect us to be explaining how we are taking that into account as we develop future policy proposals, and you can expect us to be transparent, and you can quite rightly seek to challenge us against that going forwards as well. I've also said that part of our strategy in terms of regulatory reform must be to make sure that we're also supporting innovation. The markets around us are changing. You've seen the speed of innovation through tech, through blockchain technologies, through increasing use of AI. And I think it's really important in the regulatory system as a whole that we do retain the capacity there to support innovation going forwards, so that we're not just regulating for the problems of the past, but we're also supporting that innovation, which will sustain growth and investment going forwards as well. We at the FCA have got a really good track record for support through our sandboxes, through our tech sprint approaches, which we launched back in 2014, which are now always on. They used to be only open at certain intervals of the year, but they're now always on for people to make use of our Innovation Pathways service. And we're really committed to support that, because I think the markets don't stand still. Neither does the country that we live in, the world that we live in, its connectivity, and so it's very important that we maintain that capacity and space for innovation. I've also spent a lot of time talking about international interoperability. So when we engage with firms, people sometimes have different views depending on where they're anchored, whether they're anchored to the EU, they're anchored to the UK, they're anchored to the US, or anchored to Singapore. And I think in that context it is important that we recognise that financial services operates across borders, evidently, and as we go through this process of regulatory reform, if it's the right thing for the UK to make change, we will, but we're not going to make change simply for change's sake. The ability for firms to continue to operate across borders is important in supporting that innovation and ensuring that markets function well. On the investment front in particular, you will have seen us back in September 2021 when we published our consumer investment strategy, say that actually we want to see 4 specific things. We want to see customers that have a low risk appetite, not investing in high risk investments. We say it's fine for people to invest in high risk investments if that's what they want to, if they've got that risk appetite, but we saw a disconnect between people's self-described risk appetite and where they were putting their money. We also said that we wanted to see customers that have more than £10,000 of assets with a higher risk appetite, not keep that money in cash, because investment over the long term would be likely to be more beneficial for them. So we wanted to make sure that people were able to make informed decisions. We talk about creating confident consumers. There's a huge amount of work that across the system we can do to support that. So advice, guidance, boundary review that we're working on jointly with Treasury is one aspect of that. But I'm really struck by, there's a stat from, I think, the Boring Money put it out, 86% of consumers didn't know who to trust for investment. That's really quite significant, and actually if we want to help people make informed decisions, people need to have better levels of understanding. We at the FCA have a role in doing so, but we don't lead on financial wellbeing or financial education, but we have recognised that with those levels of understanding it is an important issue to solve. So anyone that's been to the cinema recently, Dumb Money might have seen that our Invest Smart campaign, which sits alongside our Scam Smart campaign, is really there to help people understand the basics of investment, where to go for information, where to go for help, where to go for guidance. And that's taken us as the regulator into some quite new territory, sort of social media, the cinema adverts perhaps being sort of less novel, but sort of very much on social media platforms trying to get that message out there as well. The other thing evident that we can do in relation to investment, we can make sure that the right vehicles, the right regulatory structure exists. So you will have seen us create the long-term asset fund, which is there, it enables investment in long-term assets, productive finance. We set that up, firms are now taking advantage of it, and we've also recently extended the access to certain types of retail investors as well.
Fantastic, thank you so much. And next I'm going to move on to Sir Simon Fraser, who, following a distinguished career in diplomacy and government, including as Permanent Secretary of the Business Department, is now Managing Partner at Flint Global.
Okay, thank you very much. It's great to be here. I'll just wait till the people come in and out. Okay. I'm going to come at this a little bit more from the international and business perspective, which I think is complementary. And there's 3 things I really want to say. The first is, this is a world that is changing incredibly fast, and it's an era of geopolitical tension, and that geopolitical tension is increasingly being expressed through economic means, and that is affecting the context that we're in. It means there's more interventionism by governments and there's more protectionism, and we have got to adjust to that economic security agenda, what Rachel Reeves is calling securonomics. And that's really important, but at the same time we have to bear in mind that trade and investment is incredibly important, and open markets support democracy, and therefore we've got to get the balance right. The second point is, and I'm thinking in terms of a conference with a party which is, I guess, hoping to come into government soon, whatever the actual measures that you decide to take in terms of policy, they matter a lot, but what matters as much is consistency and predictability over a period of time for investors and businesses to make the decisions they need to make about investing in this country, and that is one of our problems. And thirdly, the government has got to find effective ways of engaging with the private sector on this dialogue, and also supporting the delivery of policy over time, in order to create confidence and results. So just unpacking that a little bit briefly, on the geopolitical side, the big issue in my mind is the sort of strategic tension between the US and China and the way that is playing out across the global economy and international politics. There are of course many other issues, but we can't go into them all. But as a result of that, and COVID and Russia, Ukraine, we are seeing interventionist policies on all sides. We're seeing sanctions, we're seeing heightened security, screening of investment, we are seeing export controls, and of course measures to reduce reliance on different markets for strategic imports. But that's not an easy agenda. If you look at it, China has a 50% global market share in a whole range of industrial sectors. So the idea that we're going to decouple completely is ridiculous and also actually undesirable. So a government coming into power in this country has got to make some careful choices about how it approaches those issues and gets the balance right over time, and that's a big challenge. The UK is already moving in a more sort of interventionist direction on investment through the National Security and Investment Act that's been introduced, which heightens the ability to block investments or put conditions on them for security reasons. And there are criteria around that, but what we're seeing in reality is that a lot of those decisions have political overtones. They are political choices, and therefore investors and businesses need as much clarity as they can about how measures are going to be applied so that they get a sense of where things are going. And therefore, I go back to my point about engagement with business. There's a very good example, I don't know if you know about the National Cyber Security Centre, which was set up by the government, sponsored by GCHQ, to help engage, to talk about the issues around cyber security with business and how they affect and how government sees those. And that is the sort of approach, quite nitty-gritty, which I think will help a lot in building confidence in the investment environment. The second point I want to make is about industrial strategy. We haven't talked about this yet, but we need to. Because another consequence of what's happening is you've got these massive state subsidies now happening across the world in strategic sectors, most obviously in the United States through IRA. 400 billion, between that and $1 trillion over a decade being invested to support solar power, large capacity batteries, basically clean energy technologies in the US. And these subsidies, certainly IRA, have very important domestic content requirements, which actually mean that if you're going to benefit from the subsidy, you have to produce in the US. This is really important, and the Social Market Foundation have done research on this. You've demonstrated that there's massive $90 billion of new investment in clean energy projects in the US, but it's coming from other parts of the world as well. So it is distorting global investment markets in a way that we need to be conscious of, and that affects competition. And then you have the EU, of course, responding to that and seeking to make sure that there is investment in the European Union of a similar, on a similar scale. So what can the UK do about that? Well, that's difficult because we don't have the same scale of economy, we don't have the same resourcing, we know that the next government is going to inherit a very tight financial and fiscal position. So I think making careful choices about where our comparative advantage lies in policy backing investment opportunity is going to be incredibly important. Focusing on the areas of strength. I think again Rachel Reeves has been trying to identify these and making sure that we are not just adopting a blanket approach but focusing on our strength. So making the right choices. And my final point, very briefly, on delivery is that as I think Karen said at the beginning, the broader environment really matters, the broad policy environment. So inflation and interest rates are obviously very important for investors seeking to make choices. Governments can't control that completely, but they can avoid making things worse. That would be a very good thing to do. But consistency in the tax and regulatory environment are really important as well. Now, we have made, in my view, we have made things more difficult for ourselves through Brexit in the context of attracting inward investment. And that is a very important issue. The relationship with the EU, I mean, inward investment has plateaued or fallen, I think, since the Brexit decision. So the relationship with the EU is going to be important, and I think a Labour government, were it to come to power, would have to make some pretty tough choices about European policy, which at the moment, understandably, they're not ready to make, if we're going to make significant improvements in our trade and investment relationship with the EU. And then my final point is, on all that, it's not only about making the decisions, it's about supporting Whitehall and the private sector so that the policy machine and the private sector can work together over time to sustain delivery of the right policies.
Fantastic, thanks so much. And to round out the panel, I'm going to return to the person who wants to solve all these problems. Tulip Siddiq, who is Shadow Economic Treasury Secretary to the Treasury.
Thanks very much, Aveek, and thank you all for being here today. Thank you for inviting me to speak as well. I am Shadow Economic Secretary to the Treasury. I won't pretend I have all the answers, but I'll lay out some of the ideas we have come up with. So Regularies and I are considering very seriously what happens if we do win the next election and we are in the Treasury. And you've said this, Simon, about how we will be inheriting an economy that will be a challenging one. I mean, there's no secret about that. So there's no point in us as a Labour Party promising a string of platitudes and policies that are unfunded and guaranteeing that everything will be fixed on day one of a Labour government, because it won't be. And that's why we try to take a more meaningful approach to what happens and how do we increase investment, how do we secure finances for our country, and most importantly, how do we grow the economy. And someone said to me, it's a very ambitious target to have the highest sustained growth in the G7. It is ambitious, and that's why we're thinking about how do we get to that point. And I'm undertaking a review at the moment from my office into financial services, which Rachel's asked me to do, which is looking at what's our offer for the city, if I am City Minister, what's our vision for financial services. And Gordon Brown said to us when he was in government, which was a very long time ago, 13 years ago, and the economy grew at 2.3% a year, that his partnership with the city was fundamental to him growing the economy. So with that in mind, we started thinking about what are the things the financial sector wants in order to help us grow the economy. And I'm just going to pick up on something else you said. The number one kind of feedback that came to us is that they want a stable and secure environment. They're very worried that the successive kind of change of minister and the government means that you set a future regulatory framework, someone comes in, rips it up, and you have to start from scratch. And the point has been made to me many times that the financial cycles are not in line with political cycles, so it's not like every 5 years they can start from scratch with the legislation. So I just want to, for the start, reassure you guys a little bit, because I do feel like it's important to get this message across that we are not someone who wants to come in and rip up the future regulatory framework. That's not our intention. We're going to build on the work that's been done there, and I know a lot of people in this room have contributed to it, and we want to build on the reforms that are there. I took the Financial Services and Markets Bill through Parliament from the Labour Party, and, well, I initially started off with John Glenn, then went to Richard Fuller, and then went to Andrew Griffiths, but with all three of the ministers, I mean, we worked very constructively across, because we thought the legislation proposed in there was largely what we wanted to do as a Labour government. And the things that I challenged the government on in the Financial Services Markets Bill, for example, the intervention power, which they eventually dropped, I protested against that. I wanted them to have more legislation on cryptocurrency, and they only did stablecoins. There were things like financial inclusion I wanted in it, tackling fraud. Whereas there's things that they didn't take on, largely where we ended up in terms of legislation, we did vote for it. So we did support the new secondary objectiveness on competitiveness and growth, because we do think it's important for the UK market. We did support things like reforms to Solvency II, and that's something in the day one of a Labour government. I am committed to making sure the reforms to Solvency II are carried out, and that we don't drag our heels on this. There have been 10 changes in the last year on it, but we want to make sure we carry it out. So the first thing to do is reassure the sector that in order to have investment, in order to grow our economy, we're not coming in and making change for change's sake. There are places where we will differentiate from the government, and Brexit is one of them. We think they've botched up the deal, and we won't diverge for divergence's sake, but there are certain things that we feel could be done a lot better, which would bring investment and would help us with our economy. One of them is mutual recognition of professional qualifications across the service sectors. Absolutely, we would build on the memorandum of understanding that's come in, but we would build on that. We want a new veterinary agreement which would cover the whole country and cut red tape for business and help us speed up the growth of the economy. So for us, it's about creating a stable environment to attract investment, but also look at things we can do differently. One of the things Rachel's talked about a lot, and you heard it in her speech, was about planning. When we've been doing this report review into financial services, and one of the things that really deters people from investing in our country is our archaic planning system. I used to be a councillor on Camden Council, as you know, Aveek. Used to live there. I was around for a while. I think it was a good one, I don't know. And at that time, like, the frustration with the planning system, I think, really is a disincentive to a lot of people coming into our country. So the national policy statement on the big infrastructure projects in our country hasn't been updated for 10 years. That's something Rachel's looking at, like how do we fast track some of the really big infrastructure projects, 5G infrastructure, for example, battery factories. We looked at this figure in Shadow Treasury, which was that out of 50 battery factories in Europe, only one is in our country. I mean, that's not something to boast about. There's things, for example, Oxford and Cambridge have had 2/3 of their planning applications stuck, like not moving for science labs. I mean, think of the innovation investment that could happen if those planning applications weren't stuck, if we were building those science labs. So we're trying to take a more sophisticated view of what are the things we can do to speed up growth and investment without spending a lot of money, because there isn't going to be a lot of money for us to spend. And then for communities who are hosting infrastructure, we're very aware of this. I mean, we are a Labour Party, we want to make sure we look after our communities. There's planning legislation that could be updated to make sure that they benefit, whether that's from lower energy bills, and there's a precedent in place already for this with wind turbines. That's the kind of thing that we're looking at. And I mean, I could go on for this forever, so stop me when you want to, but the Green Prosperity Plan, without the transition to net zero, and I think the Green Challenge is the biggest economic and moral challenge, certainly of my lifetime and all of your lifetimes, there's huge opportunity for reform, for creating jobs in de-industrialised areas. Our Green Prosperity Plan is about public investment, which will then crowd in private investment and unlock capital into our country. Similar to, you've mentioned the IRA Act, Inflation Reduction Act in America, the CHIPS Act, that's the kind of thing we want to loosely base our policies on. Because if we don't tackle the investment in green industries, we're not growing our economy, I can promise you that. Germany is investing 5 times more in green industries than we are. France is investing twice as much as we are. We're falling behind. And when I've mentioned that to my opposite number, he gets very defensive, Andrew Griffiths. It is a fact. And as a Labour Party, we want to make sure we have a very clear roadmap for a transition to net zero, a green taxonomy, sustainability disclosure requirements aligned with international standards. If we don't fix this now, we are in trouble, I can tell you that. So, I haven't even got on pension reform. Okay, ask me a question, maybe, then I'll stop now.
Thanks so much. Okay, I'm going to do one question and then I'll open up to the floor, because there's a lot of you. I don't know if we'll get around all of you. Just a very basic question, which kind of touches on where you ended up, Tulip, a bit towards the end there, which is, when you speak to different people, you get quite different answers. As some people will say, oh, there's loads of cash about. Money, capital is not the limiting factor, the constraint. The constraint is investable opportunities. The issues are in the real economy. It's skills, it's infrastructure, it is things like planning, like Tulip said. Whereas on the other hand, if it is cash that's the limiting factor, then we have to get into kind of these difficult conversations. But do we need to have higher kind of levels of enrolment in pensions, for example? Do we need to raise our savings rate as a country? And also, I guess, some of the things Simon was talking about attracting inward investment becomes more of a priority. So should we be thinking about this more on the kind of demand side, or the opportunities for investment, or how worried, how much of this is a financial market as opposed to a real economy issue? Siddiq, do you want to start on that?
I'm very happy to. I thought you were actually going to ask me the question of, is regulation the issue, or are there broader factors? Because in the last 2 years that I've been at the FCA, actually, I have had a lot of conversations where people have been sort of pointing the finger at regulation being the thing that you need to solve in order to boost economic growth and prosperity. Actually, in the few days that I've been here, the conversation that I am now having is underpinned by the Financial Services Markets Act, which is now there. It's in practice. We're committed to deliver against it. We're committed to being transparent and accountable under the accountability framework. There's a much broader conversation, which you've just already highlighted in your question: infrastructure, skills, tax treatment. Those are the issues that have been raised in my presence, albeit not directly with me, because of course government lead on that. I wanted to just draw attention to sort of one thing, because the regulatory framework, which is obviously the part that we can, we're involved in. Now, if we get that right, it's a culture change both with firms, but also a culture change within ourselves as well. That can support future growth and innovation. If we're very clear on, as long as there's enough regulatory certainty around it, if we're very clear on the outcomes that we're aiming for, it will mean that firms can innovate, knowing the outcomes that we have in mind. We are also saying that we are prepared to do some quite bold reforms if that's the right thing for the UK to do, and we want there to be a public dialogue on this. So a good example of that is listings reform, where we've come out earlier this year and said we are quite prepared to have to make some quite bold regulatory changes. We are seeking views, we have consulted, we've been convening round tables, and we have talked about the need for consensus as much as possible, but not necessarily sort of compromise on each issue, because compromise on each issue tends to not keep anybody happy actually, because there's just compromise on too many parts, but we want there to be consensus. We do recognise that that involves the reforms that we went out with early consultation on do involve a different balance of risk, and so we want that to be a public dialogue, a public discourse. It's important that decisions around where that balance of risk should sit are informed by external views, and I think that's the role that we can play as a regulator as part of a broader system. Different sort of subject matter, but in financial crime, which I often also talk a lot about, we can't solve financial crime by ourselves as the FCA. We work in partnership with others, and I think in relation to the really challenging question around sort of investment opportunities, economic growth and prosperity, the FCA plays a role in the system, but we are not the only participants, so it's how we work with others, how we support that future growth and innovation, how we support outcomes-focused regulating and playing a part in the ecosystem as a whole that's important.
I feel like I'm taking the easy way out, but you've asked an either-or question. I just don't think it is an either-or. Is it about more money or is it about investable opportunities? And there are reasons you need to do both. Very clearly, there are reasons why we need more individual saving, we need larger pension contributions. You know, some of those are about getting more investment into this country, but it's also just about the financial resilience of it, the resilience long term of a population that is simply not saving enough for their retirement. So I don't think it's an either or, but also I don't think there is a simple solution. Let's just fix this one thing. And sometimes as a trade association representing quite a lot of diverse operators, we tend to say, well, there's a very, very long list of things that we would like to change. Sarah's received a few of those lists, I'm sure, for us. But I think what you have said, Sarah, is really important, which is these are complicated problems with lots of different players. And the only way, and I think all the players have the same objective or the same outcome in mind, right? We all want to have, you know, infrastructure for our own interests individually, but in this country that gets the investment it needs. We want to see companies in the UK get the capital they need to grow and to scale up and do all those sorts of things. So as a really the only way these are going to get resolved is opportunities for policymakers, for business, for consumers, for regulators to sit down and work together. And I can, you know, a very recent example, and it's very, very specific, but we've been working very closely right now with government, with the regulator and with our industry on how do we make the most of new technology and specific tokenization. How does that work in future? It's a competitive market globally. How do we make the UK first choice for those investments? And it's technical and it's difficult, and everyone's kind of working towards the same objective, but we'll have very different perspectives. If you are a technology lead in a firm, you'll have a different view from a regulator. And are there things in the regulation that are holding us back? Are there things in government policy? Are there things in sort of wider cultural issues? And I think this is a bit of a non-answer, but I do think I'd be reluctant to try and simplify as an either or.
Somebody going to cop out, or do you have an answer?
I'm not going to answer it at length, and I'm not an expert on issues like the retail investment market. But just from my perspective, and probably people in the room may know some of the answers, it seems to me when you look at external investors, and for example, we can talk about private equity, but M&A and private equity activity, at the moment there seems to be two problems. First of all, they find it very difficult to value assets because of the macroeconomic environment, the interest rate, inflation and so forth. And secondly, they are concerned about the regulatory context and policy context affecting the assets they may be looking at, and therefore they're very cautious about investment. I think that's a bit of what's happening in this country. So there is money there, but I think that money is not being deployed at the moment.
Yeah, sure, thanks. I'll give you a politician's answer. Okay, so I think the truth is that you want to make substantial change. There's going to be money involved, obviously. But is there a creative way of thinking about it as well with policy changes? So, for example, when I was undertaking this review, one of the things firms would talk about a lot is the lack of access to critical growth capital, right? And compared to our peers, we receive relatively little patient capital funding. And if you look at the figures, 70% of the venture capital funding in the US came from pension reforms and pension funds. In our country, it's under 20%. So we are looking at what do we do to change that, and do we consolidate DB/DC local government pension schemes to get a higher return for savers? But this is where it comes in, Aveek. I think it's not just about that, it's about a cultural reset, and it's about the way we look at the fragmented pension funds and pots in our country, and how do we incentivize pension trustees to think about investing in private capital and then get a return from that. So I don't know if it necessarily requires money, Aveek, but I think it requires a cultural reset and a strengthening of the ecosystem and convincing people to do that. And in a way, that's almost harder than money in a way, because you're really trying to change the way we think about investing here. And then there's another example I'll give you, which is a policy I'm working on at the moment. I'm working on with Phoenix and NatWest on this policy. It's about green covered bonds. It's a bit technical, so bear with me. So covered bonds, and bonds raise about £200 billion anyway, and covered bonds is very low risk because it's borrowed against an asset, which means that it's something we can utilise. At the moment, banks won't lend covered bonds for green assets, and it will take a legislative change, either a statutory instrument or the FCA to approve of it, as FCA covered bonds are approved. It won't cost the taxpayer any money, but if I could unlock even 5% of the 200 billion, then I'm unlocking 10 million of investment into green industries. I think if we think a little bit about what are the changes we can make without using lots of money, like legislative change, small changes which isn't the cost of taxpayers, it's one of the few financial instruments that didn't collapse during the financial crisis. It's obviously a safe one, low risk. I think there is a way of creatively thinking. I don't think it's a silver bullet, and I don't think it solves every problem. But frankly speaking, we could use a lot of help in the economy right now. So I think creative thinking will probably get you to an extent. But if you're borrowing to invest, I think that's also a solution. And it's more about one of our fiscal rules, which is hard and fast, and Rachel will not move from this, is not borrowing to cover day-to-day spending, and I think that's very important. And then, about reducing debt as a share of the economy, obviously that's one of them. But the politician's answer is, it's money and creativity and legislative change.
Right, I'm sure you've got lots of questions, so yeah, put your hands up and I'll take a few. Gentleman there?
Hi, Zach Sharif, Citywire. Should pensioners still expect to see the lifetime allowance reintroduced? How would you justify that to them? Could you also provide details on the targeted scheme for doctors that Rachel just spoke about introducing?
All right, lady there.
My question is around how does aging, the fact that we're an aging society, go into this, and how should it affect the solution? So we're looking at, both in terms of skills, in terms of where the wealth sits, in terms of changes to pensions. Yeah.
Fantastic. And up here in front.
Yeah, hi, it's Anne Fairweather from Hargreaves Lansdown. How will a shift to more outcomes-focused regulation support consumers building their financial resilience?
Great. Should we start with Sarah on probably the last one, and anything else?
Question: how does focused outcomes focused regulation help consumers and sort of building resilience? I think if you're thinking about sort of financial resilience and do people understand how to make informed choices about what to do with their money, I think advice guidance and the advice guidance boundary review is one of the most significant developments for us all actually in the months ahead. Jointly with the Treasury, we'll be publishing an updated statement on that in the autumn. What I've said in other environments, it's really important that we engage across industry and consumer groups in terms of getting that right. That will take some time to deliver, and so what we've said in the meantime, we want to make sure that firms have the confidence to get up to that boundary right now, which is why you see us issue guidance back in August to say, because we see a range of different risk appetites across different firms, across different parts of the industry. We will be approaching that with sort of outcomes-focused principles in mind. We've issued some principles jointly with the Treasury earlier in the summer to say about how we will approach this. We've highlighted that there will be potentially different considerations of risk. We do know that it's important that wherever that boundary is set, there's got to be commercial viability in order to encourage firms to change their business models to take advantage of the new advised guidance boundary. If you take the step back and say, well, what's all of this for? This is to make sure that people have help at the right time, guidance at the right time, advice at the right time in a way that they can afford. So advice guidance is one part of the solution, but actually it's not where you draw that boundary, and legislation is never the full answer. It's about how firms operate, whether consumers have the levels of understanding and just generally levels of understanding around how to sort of make use of your money.
Sure, do you want to come in next, and particularly on the lifetime allowance question?
I think the policy's still being decided on that, and I'd rather not tread on someone else's toes, because it's not actually going to be my policy. And the policy's still being decided on that. And for the FCA, we want to make financial inclusion a part of the consumer protection angle. And one of the things I just want to pick up on that briefly is, if we're talking about financial advice guides and financial inclusion, when I talk about in-person banking services, I don't just mean keeping bank branches open, because if a bank branch is generally not being used and it closes down and there's a reason for it, that's different. But I think the in-person banking services and the lack of them is actually really contributing to the problem of financial exclusion that we have in the country anyway. And we were promised, I think it was 50 banking hubs which would have all those services provided, and only 7 of them have been delivered. And that's going to be definitely one of the policies for the Labour Party that we'll be looking at, to see how do we provide these services if a bank branch does close, because we're really cutting off a huge chunk of people who need that advice. And in terms of skills, I just want to pick up on the ageing population, the skills question. I'm relating it to skills because I think it's really important. We're talking, because of the lack of investment in fintech, we're talking about having tech hubs in every region. There's no point in us, the Labour Party, building tech hubs in every region if we don't have the people who have the skills to actually work in them. So if we have an ageing population, one of the things we're looking at upskilling our country is we want to establish an expert body called Skills England, which would have people from local government, national government, people from trade associations, people from trade unions, and politicians, but also people from the education sector, to look at what can we do to change the way we are trying to increase our talent pool at the moment. So whether that's responding to AI and new technology, blockchain technology, things like that, but also using things that are already existing, like the apprenticeship levy, and changing the way it's used. So at the moment, well, it doesn't matter what at the moment, what we want to change it to is to spend half of it on bespoke training, camps or modular training, and it's the upskilling which hasn't happened in a long time, and we're very aware that if there is a population who aren't in line with what the workforce expects you to do right now, then we won't grow as an economy.
Simon, and particularly interested in your thoughts on demographic changes, so
Well,
much there to unpack.
That was the point I was going to pick up on health. I mean, I don't know what it means for the pensions landscape. Obviously, it's incredibly important, and that is a very major issue for us and for other countries. But I just wanted to use that point to underline a broader point about, which I didn't make earlier, which I did want to make, about industrial strategy, which is that you've got to think about these things like demographic change and think forward in a strategic way about what that means in terms of the sort of services and economic provision that we need to invest in. And I do myself think that a strategic industrial strategy is necessary. It's also necessary because of the sort of choices you're going to have to make in the investment you're going to make, given that we aren't the United States and we can't do everything. And therefore I'm in favour of it. There was somebody to say to me yesterday, we should drop the word industrial. We need a different word. It's not really industrial strategy. It's sort of economic planning strategy. I don't know what it is, but it's I think it's really important. And so I just wanted to make that point on the back of your question. And then to say one thing to Tulip, my experience in government is if that's going to work, one thing that's absolutely essential is that the Treasury is aligned with the spending departments and has a broad sort of sense of common purpose about where the priorities lie, because otherwise it can get very tricky.
Yeah, absolutely. I mean, just to add one thing. I think in terms of the ageing population and preparing them as well for the workforce, which is one of the things we found, is to do the body that we want to establish skills in. It's also to look at skills trends, because I think we're quite bad at doing that. There's a gap in the market when we don't look at the skills trend and monitor it, and that's one of the things we're focused on. But I agree with you with Treasury stuff, I do agree with you.
And Karen.
Yeah, I just wanted, picking up a little bit on the ageing point, but just maybe to highlight some of the significant changes that are happening within the pensions market. And I think there is a tendency to talk about pensions as a single thing, and in fact we're talking about two very different types of products. We have, historically, many will have had the benefit of having a defined benefit pension, which is a very different scheme, and they're largely falling out of favour. There are very few of them. Most of them are in wind down. So when we talk about what pensions are doing and how they're investing, it's really important to distinguish between what a defined benefit scheme is doing, which has very specific liabilities and obligations to it, and a defined contribution scheme. It gets very complicated very quickly, and I think it's really important. But the other thing to keep in mind with the defined contribution, we are all becoming investors. We all a lot more control over with pension freedoms, and how do we make that work better? So, for the fact that there are a lot of people, the very first time they ever think about their pension is suddenly when they're retired or close to it, and what are they going to do with this, and they haven't really spent a lot of time on it. But one, I do think we need to be really careful about what we're doing and distinguish the two. And also, to a certain extent, there are lots of things that can be done on the defined contribution side, as I said, in terms of incentivising and subtly changing the cost benefit of doing different types of investment. And it's not just about the lowest cost. It's often about some of those long-term assets which pensions are set up to invest in, or could very much do. There are charge caps that get in the way. So there's, again, lots of incremental changes, but I do think one of the big changes and the big shifts we're seeing in the pension market is this end of DB schemes and the sort of growth of DC schemes, and that we do need to keep them as separate thoughts, so to speak, so we don't confuse the two.
The demographic question is so good. Let's do an event on that next. Gentleman here.
Yes, thank you. Thanks to the panel. So Adam Gagan from Revolut. So we have a lot of views on the investment climate in the UK, but the key one that our users are concerned about is the point Sarah made about confident consumers and the raft of scams and investment that people are currently exposed to in the UK. We see, I think, just on our area, around 61% of all our scams on APP are coming from social media platforms. Industry numbers are even higher, 70%. That really undermines the ability for retail users to expand access to investment. Do you see that as a problem? And also, do you recognise probably what we've done so far in the UK, things like the online safety bill, which are good, isn't necessarily going to be enough to change it?
Hi, Sheila, you mentioned divergence for divergence sake not being your policy, but by natural operation of new lawmaking there will be divergence. We're already seeing in green finance sort of an equilibrium with the FCA and their partners at SMF and other NCA sort of learning from each other and maintaining a sort of a dynamic equilibrium, or whatever you want to call it. How do you see sort of better approachment with European partners generally supporting that and providing the UK sector with consistency?
We are almost at time, so Tulip, I'm going to let you come in on that.
Okay. Look, I think what I mean is that we wouldn't diverge if it was a scheme that was beneficial to us. So you probably saw, everyone pronounces this differently, SACE, ACE and VCT, right? They were European schemes, and if they are beneficial to us, those are things we would keep. But I guess what I was trying to say is that we wouldn't ramp up the divisive rhetoric with our closest trading partners. If something is genuinely working for us, of course we're going to utilise it to grow our economy. We can talk a bit more in detail, but that's essentially my point is, if it's beneficial for us, it's schemes that work for us, and we can still use them having left the European Union, of course we will. And in terms of the scam question, which I know you've done a lot of work on, during the Financial Services and Markets Bill, I tried to table an amendment which was about data sharing, because I thought one of the main problems we have is that all the moving parts are not working together to tackle this very big problem we have of scam and fraud. And it would be like the banks and the government and PayPal and all the service providers all sharing data, because when I'm speaking to the service sector, it feels like one of the biggest problems is that they report fraud. This is one of the banks sent to me. We report fraud and it falls into this deep, dark hole and nothing ever gets done about it. So unless we get to the position, and the government voted against my amendment, but it get to a position where we're actually data sharing and saying this is what's happened, that's what happened, and follow it up. We're not solving this problem. So I recognise whatever the problem is in the economy, but we don't have the solutions, and I don't think the legislation at the moment is enough. You're absolutely right to say that, which is why I try to push more, but in opposition you don't win everything you want.
Sarah, any thoughts on fraud and scams?
Well, I mean, we've made it one of our 4 supercharged commitments in this year's business plan. It's really important to maintain the confidence that you're talking about. FCA, part of a broader ecosystem, but 40% of all crime, fraud, I think are the stats that I can give you. Sort of 78% of people are online, and 18% of that originated from the telecom sector, with 44% of the losses. So it's a significant issue. Everyone in this room will have had an experience themselves, or family member or friends, in relation to fraud, and that's not good for the UK.
Karen, I think it's the last word for almost running out of time. So any thoughts on any of those?
I just wanted to thank our panelists and appreciate any of the questions, and I'll leave you to wrap up.
Fair enough. Okay, in that case, given that we're just about at time, all that remains for me to say is thanks to the Investment Association for sponsoring the event, thanks to all the panellists for their thoughts and insights, thanks to you for your very pertinent questions, and enjoy the rest of your conference.